What if I told you that the global banking system doesn't actually run on free markets, competition, or even national laws? What if the most powerful financial rules shaping your life were never voted on, never debated publicly, and never explained to you? These rules decide who gets rescued in a crisis, who collapses, how money is created, and why the same institutions keep winning no matter how badly they fail. Most people think banking rules are boring technical details, but hidden inside those rules is a silent hierarchy that determines who carries risk and who gets protected. Tonight, we're exposing the global banking rules you were never supposed to notice where they came from, why they exist, how they quietly broke the world economy, and why they're still shaping your future right now. And by the end of this video, you may never look at a bank, a bailout, or a financial reform headline the same way again. To understand modern banking rules, we have to go back, not to Wall Street, but to fear. In the early 20th century, banking systems were chaotic. Banks failed often, depositors panicked. Governments lacked control. Money was tied to gold, which limited how much governments and banks could create. Then came World War I, followed by the Great Depression. Entire economies collapsed. Banks failed in waves. Governments realized something terrifying: if banks fall, everything falls: jobs, trade, social order, even political stability. This is where the real story begins. Behind closed doors, central bankers, regulators, and economists began designing a new system. One not based on trust in gold, but trust in rules. Rules that could stabilize banks, rules that could control risk, rules that could prevent collapse. Or so they claimed. In 1930, a quiet institution was created in Switzerland, the Bank for International Settlements, or BIS. Most people have never heard of it, but central bankers call it the central bank of central banks. Its job: to coordinate global banking rules across borders without public interference. Decades later, after repeated financial shocks, a committee formed under the BIS, the Basel Committee on Banking Supervision. This committee didn't write laws, it wrote standards. But here is the trick: when the world's biggest economies agree on a standard, it effectively becomes law everywhere. This is how Basel I, Basel II, and Basel III were born. Each version promised safety. Each version claimed to reduce risk, but each one quietly rewrote who was allowed to take risks and who paid the price when things went wrong. At the heart of global banking rules is a concept called capital requirements. In simple terms, banks are supposed to hold enough of their own money to cover potential losses. Sounds responsible, right? But here's the detail most people never hear. Not all assets are treated equally. Government bonds are considered risk-free. Mortgages often receive low risk weights. Complex financial products, sometimes magically safer on paper than small business loans. This creates a perverse incentive. Banks are rewarded for growing larger, buying government debt, securitizing loans, avoiding real-world productive lending. Meanwhile, lending to small businesses, startups, or local economies often carries higher regulatory penalties. The rules don't encourage safety. They encourage scale and conformity. And as banks grew larger, something else happened. They became too big to fail, not by accident, but be designed. By the early 2000s, banks had mastered the rules. They appeared safe under Basel II standards. They held adequate capital. Their model said risk was low. Then came 2008. Mortgage securities collapsed. Liquidity vanished overnight. Banks that were well capitalized suddenly couldn't survive a few weeks without emergency support. And here's the uncomfortable truth: the global banking rules did not fail randomly. They failed systemically. Risk models assumed housing prices wouldn't fall everywhere at once. Capital buffers were designed for normal times, not panic. And regulators trusted banks to measure their own risk. Honestly, when the system cracked, governments stepped in. Trillions were created. Banks were rescued. Losses were socialized. The rules protected the system, but not the public. After 2008, the promise was clear: this will never happen again. Enter Basel III. Higher capital requirements, liquidity coverage, ratios, stress tests. On the surface, it looked like reform, but underneath, the same structure remained. Big banks still had advantages. Government debt still received special treatment. Because banks were safer, risk migrated elsewhere. Shadow banking, hedge funds, private credit markets unregulated, leveraged the rules didn't eliminate risk. They moved it into darker corners of the system. And today, global debt levels are higher than ever. Asset bubbles are larger. Central banks are trapped. The system didn't heal, it adapted. Every crisis produces the same cycle. 1. Shock. 2. Emergency response. 3. New rules. 4. Complacency. 5. Bigger shock, because global banking rules are designed to protect institutions, not stability. They assume growth will continue, liquidity will always return. Confidence can be engineered, but confidence, ISNT, a formula, and the more complex the rules become, the fewer people truly understand them, including regulators themselves. This creates a dangerous illusion of control. Look around today. Banks hold massive amounts of government debt. Central banks sit on trillions in assets. Interest rates are weaponized to fight inflation caused by monetary expansion. When stress appears, whether in regional banks, sovereign debt, or currency, markets, the response is always the same. Liquidity, guarantees, intervention. The rulebook hasn't changed, only the scale has. And once again, the public is told, trust the system. 3 clear takeaways. Takeaway hash 1. Global banking rules shape the economy more than elections, but operate outside democratic oversight. Takeaway number 2. The system doesn't remove risk, concentrates it, hides it, and delays the consequences. Takeaway number 3. Every reform strengthens the system's dependence on central banks, making future crises larger, not smaller. The most important banking rule isn't written anywhere. It's the assumption that the system must always be saved no matter the cost. But a system that cannot fail, cannot self-correct. And history shows us what happens next. If you want to understand how money really works, not how it's advertised, this channel exists for you. Subscribe to Credit Clever. Share this video with someone who still believes banking rules are just technical details. And comment below. Which hidden rules shocked you the most? Because the rules you never notice are usually the ones that control everything.